What's up, guys? It's Shafe. Welcome to Mortgage 102. First off, I want to say that I appreciate all the comments and all the interest that I generated in my first episode of this series, which is Mortgage 101. You guys are asking a lot of great questions, but a lot of you are asking a lot of advanced questions that we won't get until like Mortgage 500 or something like that. So what I want to do is I do want to work this in progressions. I want to build on the knowledge that we've already acquired in Mortgage 101. So we will get to your questions about secondary market operations and yield spread curves and all that stuff. I know that I had a couple questions regarding that, but unfortunately it's not going to be for a while. So if you can hang in there for me, I appreciate it. Or if you'd like to PM me, I'd be more than happy to answer some questions if you send me a PM, okay? But if you're waiting for a video, it might take a while to get to that. Okay, what I want to do with Mortgage 102 is I want to build on the knowledge that we had in Mortgage 101. So to recap Mortgage 101, we discussed 3 pillars of getting approved for a mortgage: debt-to-income ratio, or DTI, loan-to-value ratio, or LTV, and credit score. Okay, so today we're going to expand on those 3 categories, and we're also going to add a 4th one. And if I have time, we'll talk about something called compensating factors. Okay, so debt-to-income ratio. There are 2 different debt-to-income ratios that an underwriter will calculate. Last time when I said debt-to-income, I was just referring to what's called the back-end debt-to-income ratio, which is your total debt compared to your income. But there is another debt ratio, and it's called the front-end debt ratio, and that is just your mortgage payment compared to your income. So let's say that you have a very conservative mortgage company and they don't follow the 45%. They are more conservative, so they want 28% front end, 36% back end. Okay, so let me give you an example of that. This might not be a very realistic example, but just for simplicity, let's say that you make $10,000 a month. That means that your mortgage payment in this scenario cannot exceed $2,800 per month, and your total debt cannot exceed $3,600. So as we discussed last time, total debt does not include your grocery bill, your gasoline, your electric bill, your phone bill, any of that stuff. So moving on to loan to value. There is also a second type of a loan to value that you can calculate, and that you will calculate typically, and that is something called CLTV. CLTV stands for combined loan to value. Now, when would that be something that we would use? When there's more than one mortgage, right? So you've got your first mortgage and you've got a second mortgage, which would be a home equity loan or a home equity line of credit. So let's give you an example here. You have a home, and once again, for simplicity purposes, let's use nice round numbers. You have a home that's worth $100,000. You have a first mortgage of $75,000, and you have a second mortgage for $15,000. Okay, so you have an LTV of 75% and a CLTV of 90%. I hope that makes sense for you. Now let's expand on the credit score aspect of it. Okay, I know I talked about minimum credit scores, I talked about medium credit scores and good credit scores. Let's talk about which credit score the bank is actually going to look at. What the bank has a policy of doing is taking the lowest middle credit score. Okay, so what does that mean? If you have 2 borrowers on the loan, you have Mr. Smith and Mrs. Smith. Okay, let's give you an example here. Mr. Smith has an Equifax credit score of 722, an Experian credit score of 685, and a TransUnion score of 753. Okay. Mrs. Smith has an Equifax credit score of 652, an Experian credit score of 682, and a TransUnion credit score of 714. Now, there's 2 middle scores, right? The middle score for Mr. Smith is 722, and the middle score for Mrs. Smith is 682. The bank is going to take the lowest middle score between the 2 applicants. So, my question to you is, if the minimum credit score you need for the particular program that they're applying for is 720, do they qualify for it? And the answer is no. Mr. Smith may qualify for it on his own, but because Mrs. Smith is applying with Mr. Smith, they're going to take the lower of the two middle scores, and they're going to say that their combined credit score between both of them is 682, and that's what they're going to use. Which is why sometimes you see people applying for a loan together, and then in the middle of the process they decide to take the co-borrower off the loan for qualifying purposes, especially if Mrs. Smith is just a homemaker and she doesn't contribute any income. She's not helping the situation with any income. She's actually driving up the debt ratios because she has a couple credit cards on her credit report that are adding to the debts. So not only does Mr. Smith benefit by getting a higher credit score without Mrs. Smith, but he also eliminates some debts out of that situation. This happens all the time, which is why sometimes you will hear people say, yeah, I got a loan, but my wife's not on it, or yeah, I got a loan, but my husband's not on it, okay? So let's get into the fourth pillar of getting approved for a loan. It is your assets, right? And we're just talking about financial assets for the most part, okay? Now I know people will say, well, I've got gold in a safe, or I've got some fine art hanging on my wall, and that's worth a lot of money. I've got equity in an insurance policy. I've got some antiques that my great-great-great-grandmother left me, and they're up in the attic or something like that. A lot of people are going to say that those are my assets. My car is paid off, and that's an asset. The bank, you're really stretching it if you're using those assets with a bank to get approved for a loan. What the bank wants to see is they want to see money in an account, okay? And the number one thing that you want to provide to your bank when you're applying for a loan is basically liquid assets. We're talking about money that's in a savings account or a checking account or a money market account. If you have assets like that and it's enough, then just submit those assets to your loan officer. Don't worry about your 401k, don't worry about your IRA, don't worry about any other type of retirement accounts that aren't, quote, liquid. Most of the time, the bank will just, especially in a refinance, will just want to see 2 months of mortgage payments in liquid assets. So if you have a mortgage payment of $1,500 that you're trying to get approved for, and the bank just requires 2 months of liquid reserves, then the bank will just want to see $3,000 in a savings and or checking account. You can combine them, you can do either or. If you don't have that, then that's when you're dipping into your 401k account and showing that to them. IRAs, 401ks, whatever. I think I said 401k twice, but whatever. You know what I mean. That's when you're dipping into your non-liquid assets. So the basic rule of thumb is don't give the loan officer what he didn't ask you for, okay? Wait for them to ask for it and then give it to them. Don't give them extra stuff. Never, ever, ever, ever give extra stuff, because the underwriter has to look at it. The more stuff you give, the more red flags that could pop up, the more questions that they could have that they're going to want you to write letters of explanation on, or they might just flat out decline the loan because they saw something in there that they didn't like. So basic rule of thumb, if they didn't ask for it, don't give it, okay? We do have a little bit of time left here, so what I want to talk about are breaking these rules. Okay, how do you break these rules? When a bank says, we will not allow your debt ratios to be higher than 45%. How do you break that rule? Is there any way to get around that rule? Absolutely, yes there is. And it's something called compensating factors. Okay, so let's talk about that for a second. If a bank's maximum debt ratio is 45%, and their maximum loan-to-value ratio for the same program is 80%. And their minimum credit score for the program is 680. Okay. Now let's say that you meet 2 of those criteria. You actually exceed 2 of those criteria. But your debt ratios are 52%. So your debt ratios are 7% higher than what they want them to be. Well, the other 2 pillars of getting approved for a loan better be much better, right? So if our maximum LTV is 80, but you're at 62% loan to value, well, that's a compensating factor. If the minimum credit score is 680, but you have a 746 credit score, well, that's a compensating factor. If the minimum assets required to get approved for this loan is 2 months of mortgage payments, but you have 18 months of mortgage payments in liquid assets in a savings account, well, you have several compensating factors. So the underwriter is going to look at that and they're going to say, you know what, even though his debt ratios are a little bit high, he's got a lot of cash to fall back on. If he has trouble making his mortgage payment, he can dip into his savings. He has a lot more equity in his home, therefore he's much less likely to walk away. His credit score is phenomenal. It's a 746 credit score. You know, that means that this person, even though their debt ratios are a little bit high, they're really, really good about paying their bills. They have a proven track record of paying their bills. Let's go ahead and approve this loan for them. And that's what happens lots of times. That's something called compensating factors, and that can happen not just with debt ratios, although that is the most common. That can happen with a lot of things. If you have if you need 2 months worth of assets and you only have 1.5 months worth of assets, then you need compensating factors. You need a much higher credit score, lower LTV, lower debt ratios, what have you. So there are several times when you can break the rules. So don't be afraid to ask, right? Knowledge is power. When you're talking to a loan officer, you're trying to negotiate and get a refinance. You're trying to negotiate and get, and you're trying to purchase a house. And you have there are a lot of inexperienced loan officers out there who just don't know what they can ask for. And when you have all this knowledge in your corner and the loan officer says, look, you know, your credit score is just below where we need it to be, the first thing out of your mouth needs to be, well, do I have any compensating factors, right? You need to push that loan officer or whoever you're talking to dig in and ask the underwriter. Send an email to the underwriter and ask, can I get qualified? Does this person have enough compensating factors to get qualified? And shop around. That's my biggest piece of advice to you, is shop around, because there are a lot of loan officers that just don't know what they're doing. There are a lot of banks that can offer you lower rates just because they want your business more than this other bank. So shop around, and knowledge is power. Good luck.